Today, I'm going to show you a tax planning strategy that I use with clients at DocShop Financial, and it helps our clients save tens of thousands of dollars in taxes. And it's really wonderful for retirees who are looking to make sure that all of their taxes are optimized. I'm Raul Shah. I'm the CEO of DocShop Financial, and I use this strategy with our wealth management clients all the time. So let's jump right in. Asset location is very simple, and it's a strategy you probably have heard of before, or it's a strategy that you might be confusing with asset allocation, which is completely different. But asset location is exactly what it sounds like. Asset location is trying to put the right investments in the appropriate investment accounts to minimize your overall taxes. So the most common example that I would use is people have money in their traditional IRA and they've got money in their Roth IRA. And what a lot of times people will do is they'll buy stocks in their traditional IRA instead of their Roth IRA. Now, what are the problems with doing that? Well, the problem lies in how these accounts are taxed. In your traditional IRA, you're going to pay ordinary income tax on all of your withdrawals. So if you have a stock that goes up 10 times, well, you're going to pay a massive chunk of those gains in ordinary income tax. If you compare that to the Roth IRA, if you have a stock that has massive gains, well, you won't pay any income tax on those gains, assuming you follow the rules, being over 59 and a half, and you've had the account open for more than 5 years. So the difference in taxation is tremendous, and that's what asset location is all about. So we're going to use an example of a portfolio comprised of 50% of NVIDIA stock and 50% of US Treasuries, and that'll give you some numbers and really help you understand the concept better. So the first thing we need to understand is that we have 3 different types of accounts. We've got our tax-deferred accounts, we've got our taxable accounts, and we've got our tax-free accounts. Now, what's the difference? Tax-deferred accounts are like your traditional IRA, your traditional 401k, traditional 403b. These are accounts that you put money in, you make contributions, and you generally get a tax deduction. The money grows tax-deferred, meaning that there's no taxes in these accounts until you withdraw. And when you withdraw, you pay ordinary income tax in this account. And that's why you see right here, I've got ordinary income tax. So when you think tax-deferred, think ordinary income tax. The next type of account you have is your taxable account. That's like your brokerage account, right? Kind of the standard account that we all think of when we have investments. The brokerage account has capital gains tax applied to it. And long-term capital gains tax is very favorable. And I'm going to get into the differences in just a second. Then we've got our tax-free accounts. This is like our Roth IRA, our Roth 403b, our HSA account. And these accounts have no tax. And that's a little bit misleading because we have to pay tax to put money into the account. But all of the growth is going to be tax-free if we follow the Roth IRA rules. So now that we understand the 3 different types of accounts, we can kind of get a picture or a sense of the planning strategy, the tax planning strategy that we can apply here. If we have an account, a tax-deferred account that gets hit with high ordinary income taxes, maybe we want to put our slowest growing investments in that account. And on the other hand, if we've got our tax-free account that has no tax on the gains, well, we want to put our most aggressive or fastest growing stocks in our tax-free account. Now, in our taxable account, that is sort of like a pay tax as you go account. Every year that you accumulate gains, whether that's a short-term gain, a long-term gain, dividends, interest, you are going to pay tax on those gains in the year that it happens. So we want to put our tax-efficient investments in our brokerage account. And I'll give you an example of what this looks like for all of the accounts in just a second. But first, let's go back to that example with 50% of your money in NVIDIA and 50% of your money in a US Treasury. If we put all of those assets in our tax-deferred account, well, let's take a look 10 years into the future what our tax planning would be, right? Because when I'm working with clients at DocShop Financial, we're always looking at future projections and trying to minimize the after-tax impact of every investment that we're making. So in 10 years, let's say NVIDIA is worth $200,000. So you have a long-term capital gains of $150,000. Let's say that your bonds are paying 4% in interest a year. So in 10 years, you have $20,000 in interest. All of those gains are going to get taxed at your ordinary income rate in retirement. And let's say that that rate is 24%. Well, you've got $150,000 in long-term capital gains. You've got $20,000 in interest, and you're paying 24% in tax on those for a total of about $41,000 in taxes. That's quite a bit. Now let's take the same investment portfolio, but we're going to pick it up out of the tax deferred account and we're just going to put it in our brokerage account. And let's see the tax implications when that happens. So same situation. We have 50K of NVIDIA stock, 50K of 4% US Treasuries. The gains are the exact same. It's $170,000 total, but your brokerage account qualifies for long-term capital gains tax. That means that the $150,000 gain in NVIDIA is likely going to get taxed at 15%. Could be more, could be less, just depends. But it's very likely it will be 15%. Now, the interest of $20,000 is going to get taxed at your ordinary income rate. That's just how interest is taxed in terms of a U.S. bond. So your taxes owed in that case would be $27,300. Pretty big difference from the tax deferred account. So you can see that the same investments placed in different accounts have wildly different tax outcomes. Now, if we take it a step further and we put everything in our Roth IRA, remember, all the gains are tax-free. Doesn't matter if it's $170,000, if it's $1.7 million, it doesn't matter. They're all tax-free. Now, you have to keep in mind with the Roth accounts that you did pay tax when you put money into the account. And if we assume your tax rate was 12%, well, you paid $12,000 to put money into the account to make those contributions, but all the gains are tax-free. And so if we take a step back here for a second, we've got three different investment account types: tax deferred, taxable, and Roth. And we've got the same investment portfolio placed in each one, but we've got wildly different tax outcomes, meaning that our after-tax money, what we get to keep and put in our pocket, is very different. And what I have found is that most people do not pay attention to asset location. They're just putting stocks and investments and just random portfolios wherever their money is. When I work with clients at Doc Shaw Financial, we're looking at your portfolio in totality, and we're trying to figure out how to maximize your after-tax income, how to pick which accounts to put what investments in. Now, I want to give you a general framework so that you can understand this for your own portfolio. Now, generally speaking, in tax-deferred accounts, because they get hit with that high ordinary income tax, we want to put our slowest appreciating assets in that account. So things like US Treasuries, corporate bonds, REITs, money market funds. In our taxable account, we want our most tax efficient investments because we are paying tax as we go in that account. Every time we realize a gain, we're going to pay tax in that year. So we want things like broad market index funds in that account, ETFs, muni bonds, stocks, and REITs are also appropriate in this account because of that favorable long-term capital gains tax treatment. And in our Roth accounts, our tax-free accounts, those are the accounts that we want to put our fastest growing investments in. So our growth stocks, our small cap stocks, if you own crypto, speculative investments, those are the types of things that you want to put in the Roth account, because if they go up dramatically, you don't pay any tax on those. You don't want to take those and put it in your tax deferred accounts where if they go up a lot, a quarter of those gains are just going to get taken away from taxes. We don't want to do that. So asset location is very important. It's putting the right investments in the right investment accounts to minimize your overall taxes and maximize your after-tax gains. If you're looking to have your portfolio professionally managed and have not just asset location applied to your portfolio, but a dozen other tax strategies, shoot me an email at raul@docshawfinancial.com. I'd love to hear from you and your personal situation and how I can help you. Thanks for watching, subscribe, and see you in the next video.